eating into their market share. And so they made a big change, whereas in the past, Saudi Arabia had played the role of trying to smooth out differences in supply. In this case, they decided they were going to allow extra supply to sit on the market. And many of you will remember how crude oil dropped from over $100 a barrel to as low as $26 a barrel by February 2016. And the intention there was to bankrupt the US shale industry. You had this relatively new industry with high costs, high marginal costs, and certainly high fixed costs, still figuring out exactly how to perfect the technology it was using. And they felt very vulnerable to a sudden drop in price. And the huge success here was that the shale industry did what makes America great, quite frankly. They responded by innovating, by driving costs down, by using technology smarter. And what you see here is you see a dip in oil production, but not back to the levels prior to the shale revolution. And it dropped by about 1 million barrels a day, between 1 and 1.5 million barrels a day. And the result was that OPEC was suffering an enormous drop in revenues. Many OPEC nations, starting with the Saudis, rely on oil revenues to fund substantially all of their government spending. And they concluded that it was an unworkable strategy. And so I think this is just a fantastic story, because you've got all of the OPEC nations plus Russia, all of these governments trying to bankrupt a sector of the US economy. And that sector of the economy just came right back and responded by innovating and succeeding. Without federal government support in the US, the US government wasn't saying, "Oh, we're going to help you out," or we're going to do this for you, do that for you. This was just the free market at work. And the result, of course, was that OPEC capitulated. They allowed the price of oil to go back. And the US has been gaining market share and producing more oil and more gas ever since. And just about any way you could measure, this is the most fantastic success story for the United States. So people who are not that closely involved in the industry hear about horizontal drilling and fracking, and they might just assume that, well, that's just how the world produces oil and gas nowadays. But in fact, fracking and horizontal drilling is almost entirely a US story. And it's because there's a lot of pieces that you need to have to make it all add up. And I've listed them here. Obviously, the geology, the water, the labor force, access to capital, strong entrepreneurial culture. But one that people rarely appreciate is privately owned mineral rights. And so we sort of take it for granted in the United States that if you find crude oil or natural gas on your property, that it's yours. But that is almost unique in the world. Every other country we've looked at, mineral rights belong to the government. And this has been a huge and I think underappreciated factor, because the result is that when an oil company wants to drill on somebody's property, they negotiate with the property owner, and there's sharing of mineral rights and royalties, and both sides come to an agreement and the oil gets produced. And you contrast that with, well, Britain, in fact, where there's been an effort to frack for natural gas supplies in Yorkshire, which is in the north of the country, roughly, I think, 200 miles north of London. And there, the mineral rights belong to the government. So the government's done a deal with a local company to drill for gas, and the community there, because this is happening under a community, of course, gets all of the disruption, because fracking and drilling for oil and gas are a noisy, dirty, disruptive business. The community gets all of the downside with really none of the upside. Whereas when that happens, at least is benefiting in some of the economics. And so the result is that America is more than 95% of all of the shale activity that takes place in the world. And while there are some efforts to use the same technology in other places, Argentina, for example, there's been some efforts in China. None of those have succeeded. Argentina, of course, they're trying in a very remote part of the country. Access to capital is, of course, a huge problem for Argentina with their history. In China, the water is not where the resources are for oil. And so they have a big challenge in terms of moving water to where it needs to be. So America has a lot of natural advantages, but a lot of institutional advantages in terms of privately owned property rights, in terms of access to capital and the labor force and so on, that really make this a fantastic success story for this country. So this slide, and I've got 3 slides here that show just how much production has grown. This is shale oil production. So this is excluding conventional oil production from places like Alaska and other conventional fields onshore in the Gulf of Mexico. And you can see how it's absolutely taken off, and it's growing more than 1 million barrels a day annually to this point, from, you can see what was an extremely low base prior to about 2011. Natural gas is an even more dramatic story. And you can see how much this is going. And the US is fast becoming one of the biggest. We are actually the biggest energy exporter, and becoming first one of the biggest natural gas exporters in the world. In fact, I was in Pennsylvania. We're based in New Jersey, but I was in Pennsylvania a couple of years ago speaking at an event, and I was chatting to a landowner. And as you probably know, there's a lot of natural gas in the Marcellus Shale in Pennsylvania, in Ohio, and the Marcellus Shale, of course, extends further south than that, all the way down to Tennessee. And I was talking to a landowner who had drilling equipment on one corner of his property, and it was, taking up maybe 1 or 2%. He's getting $6,000 a month royalties. He's growing crops on the rest of his land. And the amazing thing about that was that natural gas, I can't say for definite those molecules, but we have shipped natural gas from Pennsylvania through Williams Company's natural gas pipeline, which runs south from Pennsylvania down to the southeast. Was originally, by the way, built to take natural gas north from Texas up to New York, but in certain places been reversed. We're moving natural gas basically from Pennsylvania down to Louisiana, where it's put on a LNG tanker and sent around the world, in a couple of cases to the United Arab Emirates, where you'd think they have no shortage of natural gas. And that's basically how good we are in America at producing very cheap natural gas. And then NGLs, which is sort of an unsung part of the story, but a very important one as well. Ethane, for example, is leading to big increases in petrochemicals facilities in this country for plastics, where it's obviously a critical building block. And so that's also been a big story. The parts of the Marcellus that produce wet gas, which comes then with propane and butane and other NGLs, tend to have much better economics than if it's dry gas, where you just get the methane and the ethane. And this chart shows LNG exports, and how they're really growing substantially from a pretty small base not so long ago. So now there's another side, or there's another very positive side to the shale revolution from an investment standpoint that I think is underappreciated outside of people who invest in the industry. And this is the short cycle nature of it. And this is, I think, one of the reasons why, from an investment standpoint, it's such an exciting place to be invested, because the oil business especially is very cyclical. Natural gas less so, because transportation costs for natural gas are such a substantially bigger portion of the value of the commodity. I mean, in some cases, shipping LNG around the world, the shipping costs are more than the value of the commodity when it leaves the US. But for crude oil is truly a global market, and crude oil can move by tanker around the world for anywhere from $3 to $10 a barrel, depending on how far the distance is that it's covering. And so crude oil has always been a very cyclical business, because there's a very long lead time in developing. And typically, big conventional projects might be 5, with then a fairly long time before that capital is recouped, 10, 15, 20 years or more. And you imagine yourself sitting there pondering that final investment decision, whether to go ahead, and you're going to worry about a global GDP, about production costs, about the price of oil. And today you're going to worry about climate change and potential change in public policy around the world, which will affect demand for your product. And so shale is very different. And we have a chart here where we try to demonstrate that. So the blue here represents the cash flows from a conventional oil or gas project, and the horizontal axis there is in quarters. So it might take up to 5 years to fully develop a project for conventional oil and gas. And then you might be looking at anywhere from 5 to 20 years or more to earn back that investment of capital. And it's obviously an extremely long-term decision with a lot of uncertainty. And the beauty of shale is that with shale, we drill thousands of wells in America. There's about 1 million oil and gas wells today in America. We drill thousands every year, and it costs around $7 million to drill a well. And the nature of shale, of course, is that the oil and gas comes out under very high pressure. So you can see here what we've tried to illustrate with this chart with the red section, the red shaded area, is you spend your money very quickly, but then you earn it back very fast because you get very high initial production with much faster decline curve, although you'll still get some production 5 years out from a shale well. But it means that for the producer, they're really not having to think about electric vehicles or climate change because they're going to earn their money back within a couple of years. On top of that, they're able to hedge out the risk because the liquidity in the futures market goes out 2 to 3 years. And so a shale producer can drill a well in geology that is really pretty well known and hedge out the production and have a high degree of certainty around the return that he's going to make out of that. And as long as the economics still work, then he'll drill another well. And so this short cycle nature makes it less risky. And so that's why, for example, today, ExxonMobil is the most active driller in the Permian Basin in West Texas and New Mexico. It's why Occidental was so keen to buy Anadarko. And what you're seeing as a consequence is a substantial drop in big oil and gas projects. And this chart from Wood Mackenzie, you can see that a big project where they define here one that's producing more than 50 million barrels of oil equivalent, typically, really, they're down by 75% in terms of what those projects are because they're less certain and because shale is where the opportunities are. And Exxon, last year, Darren Woods, the CEO, announced plans to invest up to $50 billion over 5 years in North America, in particular because they were looking for this short cycle type of opportunity. And so the energy business moves up and down with the price of crude oil. Energy infrastructure stocks, midstream infrastructure, which is what we invest in, that moves up and down with oil because sentiment moves up and down with oil. And yet the most enduring feature is that America is just gaining market share year after year. And I think that's going to continue for quite some time. So now, a question that we often get from people is investors and potential investors is they read about this, they hear us talking about this, say, okay, this all sounds great. Shale's a fantastic success story. American energy independence is coming. Why aren't the investors making any money? And to understand that, you have to drill down a little bit more into what the underlying sector is doing with its cash. And so what this shows, this is on the largest ETF in the sector, the Alerian MLP ETF. So this is a cap-weighted ETF for all of the master limited partnerships. And the industry's gone through a big change in terms of the corporate form it uses. And it used to be years ago that if you wanted to invest in pipelines in America, you had to invest in MLPs because of the tax code in the US. They have the ability to organize as partnerships with a big tax advantage because partnerships don't pay tax; they're pass-through vehicles, and so pipelines historically were organized form. But partnerships that generate a K1 have a very limited investor base. In fact, the investors who buy U.S. public equities are mostly institutions. A lot of them are tax exempt, pension funds and endowments and foundations in the United States, or they could be non-US institutions such as sovereign wealth funds. And none of those are able to invest directly in master limited partnerships without some adverse tax consequences. And the result is that they generally don't. It's not illegal, it's just complicated, it's expensive. Most of them don't want to do that. On top of that, when you invest in an MLP or any partnership, you get a K1. Most retail investors in America don't want a K1. Their accountants tell them not to bother with it. And so what you wind up with is a set of investors that's actually very narrow. You wind up with K1 tolerant US taxable individuals, high net worth investors, if you like, old rich Americans. That's who the traditional investor base is for MLPs. About 5% of the money that goes into US public equities. And these investors were attracted, as you can see on this chart with the distributions up until 2015, these investors were attracted by MLPs that paid healthy distributions, a pretty big percentage of their available cash flow that came with some tax deferral benefits. And they were able to do that because they don't pay tax themselves. These MLPs are not taxed. There's no sort of inefficiency. There's no double taxation of dividends with an MLP as there was with a regular corporation. So it's fine for them to pay out most of their cash in distributions. In addition to which, before the shale revolution, they didn't have much to do with their cash. Broadly speaking, up until the shale revolution, America was getting its energy from roughly the same places in roughly the same amounts year after year. So if you're in the pipeline business, there wasn't much for you to do with the cash that you generated other than obviously maintain your existing infrastructure and pay it out to investors. And so the industry attracted a very specialized investor group, older, wealthy Americans who wanted tax-deferred income and were willing to deal with the K1. And the shale revolution completely broke that model, because the shale revolution created the need for substantial investment in new infrastructure. North Dakota was not previously a source of crude oil until it was found in the Bakken or exploited in the Bakken, and required a lot of pipeline infrastructure. A lot of oil was coming out of the Bakken on rail cars, still is to some degree now. Natural gas in Pennsylvania was also a new event. And so these companies that were paying out almost all of the available cash then had to turn around and find a way to finance growth projects. And at first, they tried to preserve those distributions and use external financing to fund these. So in other words, they're making $1, they're paying out 90 cents, and then all of a sudden, they need to find 40 cents for a new pipeline. So where are they going to do that? Well, they tried borrowing, they tried issuing more equity, and neither one of those paths worked. The extra borrowing took up their leverage, rating agencies pushed back. The issuance of equity diluted returns and drove equity yields up. So eventually, they cut distributions. The key thing here is that the industry cut distributions, though, not because business was bad, but because they needed to finance growth. And it's one of the very few occasions, one of the only occasions I know actually in finance, where an industry has cut payouts to investors substantially by 36%, as you can see here, not because operating performance was down, but because all of a sudden they had a lot of growth opportunities. And in effect, what happened is this industry had attracted income-seeking investors, and it became a growth business. And you see it here. This is probably more for somebody who's heavily into finance. But on the left chart, the left chart shows basically that the operating performance of the industry was great. So it's showing EBITDA, earnings before interest, taxes, depreciation, and amortization. So a measure of cash generated was clearly growing. Those are the bars on the left-hand side, growing every year. You wouldn't even know that there was a dip in the sector looking at that. Leverage was coming down. As you can see, that's the line going across there, the yellow line with the axis on the right. And we're now running around 4 times debt to EBITDA versus 5.5 to 6 was not uncommon 5 years ago. And on the right-hand side is the index, the Alerian index. And you can see it had the most horrendous collapse. I mean, it lost, I could tell you that's 58% of its value from August 2014, which isn't quite on this chart here, but top to bottom, 58%, a bigger drop than the sector suffered even in the financial crisis of 2008. That's how much damage the industry did by concluding that it needed to convert from being income generating to growth seeking. They wound up with the wrong set of investors. And it's that disruption that even today has caused the sector to be extremely cheap, because there's a lot of investors who feel very betrayed by that. This is a slide from Kinder Morgan, which is one of the biggest pipeline companies in the country. And for a long time, Kinder Morgan had the common structure where they had Kinder Morgan Inc., KMI, the general partner that controlled Kinder Morgan Partners, which was the MLP. They had a couple other entities out there as well. But the structure was one where Kinder Morgan Partners was the entity that had all of the assets, that owned the pipelines. And Kinder Morgan Inc., KMI, was essentially the general partner. And it's a relationship a lot like the one between a hedge fund manager and a hedge fund, or a private equity manager and a private equity fund. KMI told KMP what to do, and KMP did what it was told and sent cash back to KMI. KMI was always the better place to be invested. KMP was a bad experience for a lot of people. And you can see here, they used to brag about their promised and realized distribution increases year after year until they couldn't anymore. And this promises made, promises kept slide is obviously not in the Kinder Morgan deck anymore. This chart shows sort of roughly the mix. Investors in American stocks are institutions. You know, the high net worth K1 tolerant investor, we've got here 10%, probably even a little bit less than that 10%. This chart really speaks to some of the changes. Alerian has a couple of indices which are all MLPs, and this shows the market cap of the market cap of the energy infrastructure, midstream energy infrastructure that we invest in. It's about $500 to $550 billion, and you can see how that both the number and the market cap of MLPs. There's two different indices here: the MLP Infrastructure Index and just the MLP Index. But the point here is that the number of MLPs and the market cap of MLPs is shrinking. The market cap of energy infrastructure is not shrinking. MLPs are becoming a smaller part of the sector. In fact, today, MLPs are probably about a third of midstream energy infrastructure. I would say 10 years ago, they're probably more than 90%. And then this slide shows that payouts after falling for 4 years on the indices, the American Energy Independence Index, which is our index, and it's actually mostly corporations because that's what the market is. But we've projected forward, and we see distributions are now starting to go up, and that's a story that is beginning to resonate now with investors. The sector's had a pretty strong start to the year, doing better than the S&P 500, but it's still over 30% off the highs of almost 5 years ago. It was August 2014 that this sector peaked, and we're still over 30% below those highs. The S&P 500, by contrast, made a new all-time high this morning off the back of Jerome Powell's sort of dovish comments yesterday following the Fed's meeting. And this illustrates a comparison with REITs. Years ago, when I got into this business originally, we'd compare ourselves with real estate investment trusts and REITs. And then when the sector dropped 58%, we sort of stopped making that comparison. But this chart is intended to show the difference both in yields and in growth. REITs yield less, and they're not growing that fast, maybe 2% growth. This sector yields more and is growing much faster. And one of the reasons for the growth is because a lot of that money that has been redirected from distributions to new projects is now starting to pay benefits and is starting to generate increased cash. And so this is really now much more of a growth story. And investors are starting to realize this and get get interested and excited about it. Although I think there's still a long way for us to go back to where we should be. This shows from a valuation standpoint, comparing yields on pipeline stocks versus REITs. And so the blue line on here is the difference between the probably a little over 3.5%. The yield on pipeline stocks is about 3.5% wider than REITs relative to the average, which means that the sector is cheap historically relative to REITs. So there's a pretty good amount for us to come back in to really make up for that. And then this last slide, this is really just if you invest in the sector. A lot of the mutual funds and ETFs in the sector, because they hold mostly MLPs, they're subject to corporate tax. And 2013 and 2014 were two great years from an investment standpoint. but those types of funds get very high expense ratios, as you can see, because they pay corporate tax, which is not a common thing. Really today, what the world needs is funds that have MLPs below the threshold that generates a corporate tax liability, which is 25%. And so the funds that we run, the American Energy Independence Fund and our mutual fund, are both structured correctly to do that. So that's the end of my prepared comments. And so I know Connor had talked about how you can answer questions by typing them in on the chat screen that you hopefully will have available. So I'd be happy to take any questions that anybody has at this time.
Yeah, thank you, Simon. Again, as he mentioned, please go to the chat box. I'm sure there are some questions out there. This is a completely different perspective, I think, than we've used to look at our industry, at least on this webinar, for the last 3 or 4 years. And so it's really fascinating, and I appreciate you taking the time to do it. And I'm hopeful that we'll have some really strong questions here, but we'll give folks a couple of minutes to get those in before we wrap up.
Yeah, the big criticism, while we're waiting for that, the big criticism of the energy sector broadly has been that companies are too ready to invest in growth, and that there's not enough focus on return on capital for investors. And I would say, and we're in those discussions, and we feel that way too. And I think that a lot of investors are waiting to see all of this increased volume of oil and gas production turn into economic returns on their investments. And the companies are hearing that. And in many cases, they're acting on that and showing more financial discipline and doing what you'd like. But there continues to be this sort of tension between management and investors. And it's still the case today that if a company announces a big new pipeline and is excited about the growth prospects, investors are just as likely to sell the stock because of, oh boy, it probably won't achieve a return on invested capital that's adequate. I wish they wouldn't do that. And so a lot of company management still need to demonstrate that they are able to invest for their investors and generate an appropriate return over what their cost of capital is.
But I do have a question here, and it's what impact does current clean air policy have on oil E&P in the U.S.? Will states continue towards green, or will relaxed national policies prevail?
Yeah, that's a great question. I mean, climate change is a huge issue, and we spend a lot of time thinking about that. And I think it's an issue that keeps a certain segment of investors away from energy, because public policy is too hard to figure out. So I mean, at a very high level, the issues with climate change come down to two competing objectives. Developed countries want lower emissions. America wants lower emissions. It obviously depends on the state, and the federal level is starting to roll that back. But developed countries generally want lower emissions. Developing countries, think China and India, want to use more energy. And those two goals are in conflict, and climate change is going to be resolved based on how those two objectives interact. There's no way that this issue gets solved without China and India being on board. China uses 6 times as much coal as the United States. China, on a per capita basis, uses 10% of the crude oil of the United States. So you can see there's both enormously dirtier power production because of the coal, but also dramatically less actual energy usage. So where we come back is, because of the short cycle nature of oil production, we see gaining market share in virtually any scenario. I mean, I guess if oil went to $10 a barrel and stayed there for a long time, that wouldn't be so good. But I think you'd see a lot of loss of supply at that level quite quickly, and obviously increased demand. So the short cycle nature is really what I think is most positive for the US. And so oil's a global business. Oil demand is clearly going to keep growing in Asia, almost regardless of what the US does. Connor, you're going to pick the questions that we see on the chat, though, or do you want me to do that?
Yeah, here, let's just go with the next one, which is looks like Canada is the big loser due to the Permian and unconventional natural gas production domestically. And will that downturn be sustained?
Um, well, Canada's approach to its energy industry to somebody who doesn't live there, like me, is extraordinary. And the big challenge for Canada has been how do you get crude oil to market, because it's really sort of landlocked and limited in even how much can come into the US. I think that cheap natural gas is here to stay. I mean, just look at the amount that we're flaring in the Permian, in West Texas, because there isn't the infrastructure there to take it. And even though there's new infrastructure being built and invested in, I think it's going to be there for a long time. Natural gas continues to be very cheap, and so I think that that probably is to Canada's loss. I think with crude oil, there's more encouraging signs that they'll be able to get crude oil out. Although we were at the annual industry conference a few weeks ago in Las Vegas, and we had an interesting meeting with Enbridge, very big Canadian pipeline company with substantial American assets as well. And they said to us that they would not attempt a greenfield pipeline in Canada. They would not try and build a new pipeline in Canada because of domestic opposition. And the exception would be if it was just within Alberta, where they knew they'd be able to do that. But anything that's going to cross provincial lines. And so now we'll see how the Canadian federal government deals with the Trans Mountain pipeline, which, as an investor in Kinder Morgan, I got to say that when they sold that Trans Mountain expansion project to the Canadian federal government, that was an amazing deal, particularly because within about a week, of course, a court ruled that the environmental impact study had to be completely redone. So Canada is very challenged because of its internal politics, as well as the fact that the US has become a new low-cost supplier of natural gas. So here's the next question. Is the main reason for private equity investment due to the infrastructure built to serve export markets? In other words, without the export market, would there be as much interest in this sector to serve just the domestic market? Yeah, so this is a really cool question, because private equity perceives much more value in midstream energy infrastructure than the public investors do. And so it's caused some very odd things. For those who follow private equity, you'll know that the typical sequence of events is a private equity fund invests in a company and then looks to exit its investment by selling it to a public market buyer, hopefully a strategic buyer, or by doing an IPO. And yet public market valuations are so low that exit has gone for private equity investors. And so the result was, for example, that Buckeye, which was an MLP, was actually taken private by a private equity investor. And you see quite a few private equity funds that have bought positions in public companies. Crestwood, for example, is an MLP that has First Reserve as a big investor. Tallgrass has Blackstone as a big investor. Enlink has Global Infrastructure Partners, as well as Goldman Sachs. So there's a number of these. And so private equity and interest in the sector isn't just because of the export opportunity, although that certainly is there. Private equity is also there because the valuations are low. And the valuations are low because the industry switched from being an income-generating asset class to a growth asset class, but they had an income-seeking investor base. And it's still getting over the impact of those distribution cuts. A lot of investors look at the sector and say, boy, went down a lot, 36% cut in distributions. Maybe I'll wait until things have cleared up a bit. They move on to look at another sector. And I think it illustrates just how depressed sentiment continues to be in public markets. And yet there's tremendous demand for very long-lived assets that provide stable growing income from pension funds. Look at all of the demand generally for global infrastructure. So this is a data point that says to us, private equity sees a lot of value here. And that's a reason to think that ultimately public equity market values will go up, will improve, prices will rise because of that. And there are signs that you see that already, such as the transaction to take Buckeye private a couple of months ago. So, but we think the private equity involvement in the sector is very interesting. While we're waiting for other questions, we go to the annual investor conference. It was in Vegas for the first time. It used to be in Orlando for a few years. And I would say that compared with a year ago, it was a little bit better attended. Sentiment was sort of cautiously optimistic because we had a decent start to the year. A lot of focus on return of capital. A lot of focus on the impact of environmentalists. Clearly, new builds are more difficult almost everywhere. I mean, Canada's not the only place where it's hard to build new pipelines. It's very hard in New England. We still have this bizarre situation where Boston imports liquefied natural gas from abroad, from Trinidad and Tobago, even from Russia, because there isn't the pipeline capacity to take natural gas into Boston, even while there's enormous amounts of it in Pennsylvania, just a few hundred miles away. So a lot of focus on that. And I think companies are more inclined to expand capacity on an existing pipeline, to build another one along an existing one where they've already got access and rights of way, as opposed to build something new. And that's another big issue that companies are grappling with as well. Much harder to build new things than it used to be, which means that from an investor standpoint, the existing infrastructure is more valuable. I mean, there is no chance that you're going to get some new upstart pipeline company comes into this business and disrupts things. It's impossible. Tomorrow's winners are going to be from today's big companies. That's very, very clear.
Well, it's very interesting. I appreciate, again, your time, Simon. I think we've got a couple of great questions here, but it looks like we may be out for today. So I'm going to cut them off and, again, express our appreciation for your time. And, again, the recording has been made here. We're going to have that up on the Northwest Gas Association's YouTube page. Those of you who are interested in getting your hands on that, feel free to send me an email or just try and find that on YouTube itself. And we will be back next month, and we'll have an announcement out shortly about what that show will be. But hopefully something that can follow this, because I think this has been one of our more interesting ones in the past at least 6 months. So much appreciation to you, Simon.
Thank you. My pleasure. Hope that was helpful. Thanks for the opportunity.
Yeah, absolutely.